But let's begin with today's market action and those records for the S&P and NASDAQ and Apple, all ahead of tomorrow's Fed decision, not to mention a CPI report. Joining us now is Nicole Webb of Wealth Enhancement Group and Adam Crisafulli of Vital Knowledge. Good afternoon to you both. Nicole, yes, we did tick higher to record closes for the S&P and the NASDAQ, but arguably we've been grinding higher. So it raises the question, what's the next big catalyst for big market moves here?
You know, Morgan, it's one of these things where you look at the Atlanta growth print, you look at GDP, and we'd say that it's going to translate well into earnings, but I think the proof needs to be there to get the breath back in the market. And so while we've seen unit labor costs slightly down, productivity up, services, ISM, new records, you know, the market hasn't really caught up in the full breadth or the belief that we're going to carry here and that we're going to get the earnings growth that we want sub mega technology. And so I think it's just waiting for some of these proof points. And that first one might come as early as tomorrow in terms of, you know, laying the pathway for the Fed to give us a little bit of flexibility here in the back half of the year.
Yeah, perhaps we get that tomorrow with the CPI report, Adam, but we also know that the Fed's going to want to see at least a couple of months worth of that type of data with signs that inflation is again cooling, the pace of inflation. It raises the question, if we have a Fed that's essentially taking the summer off, at least according to how markets are pricing in no cuts until at least the fall, can the market continue to move higher from here? Can earnings continue to grow enough to justify the multiples we see right now if rates stay higher for longer?
I think the market has done relatively well in an environment of healthy growth, modest disinflation, and a Fed that's on the sidelines. And so if that's a scenario going forward, I think the market can survive. We will have to see a little bit of a pickup in the pace of disinflation. So the CPI tomorrow, I think, is going to be a lot more important than the Fed. The Fed's been very consistent in its messaging. The bar for incremental hikes is extremely high. We're not really even close to hitting that level. But like you said, they want to see a few more months of favorable inflation data. I think the September 18th meeting is reasonable for them to start the easing process, but it won't be the typical aggressive rate cutting cycle like we've seen over the last couple of easing processes. It's going to be a very gradual one, similar to kind of how the ECB is messaging, where they'll move for a meeting and then take a pause for one or two meetings and then perhaps move again as they digest further data. So we've been in the environment you mentioned, year to date pretty much with, again, very, very modest disinflation, a Fed on hold and healthy growth. So if that's the scenario we're looking at, stocks can survive, but there kind of needs to be a pathway towards that disinflationary process really resuming from the second half of last year. And then the Fed, commencing the easing process by the end of the summer. So by that September meeting.